I suppose looking back over the last 6 months, maybe to how markets and economies have been behaving, the irony is that the best two stock markets in the world really have been the US and China, both of which have been having rather robust, shall we say, conversations about their relationship from an economic point of view and tariffs. So, the irony of the worries around the world from investors' point of view of slowing growth, of these trade disputes, those two markets have actually been the best place to have parked your money. Now, what we're seeing is a continuation, I think, of some of the trends I've identified before. A general slowing of growth. I think what the trade discussions and the uncertainty around those and political uncertainty nearer to home in terms of Brexit is just, investors, consumers, companies are all delaying decisions. And I think that's what's causing some slowdown in terms of earnings from companies. And we're seeing it as well in terms of growth rates from countries and regions. So the UK, Europe, all slowing down, US growth rates slowing down as well. And it hasn't really affected share prices in a true sense yet, but it is affecting expectations of earnings and profits, which have been downgraded solidly all year. So I suppose turning to Bankers Investment Trust performance, it's been a very solid 6 months to the end of September. The NAV, the net asset value, has risen by about 8%. So again, given uncertainty, that's, I think, a very credible performance. But it's been choppy underlying that. Some sectors have done very well. Some markets like our China A share sleeve has done very well. US equities. Europe has been more challenging, and UK one of the most difficult, together with Japan. I think different reasons for some of these. Japan is very much manufacturing country. It delivers goods for making things and a lot of its economy, and that's been difficult, I think, given the slowdown. The UK, we know, is still uncertainty around Brexit and investors' confidence. Stocks and sectors, again, are also differing performances there. We've seen more challenging for financials, given interest rate cuts in the US and bond yields continuing to fall. It's challenging for a bank or insurance company. Retailing is difficult. Again, still the technological delivery of the internet and making it very difficult for traditional retailers. But there have equally been some high points as well. So in sectors as diverse, I think, as financial services, our credit card investments have been doing very well, and nuggets here and there in certain growth sectors. I think if we move to tactical positioning within the trust, I still have worries that the markets have moved ahead of reality, ahead of expectations for earnings. And we've had a strong year for equity markets, as I mentioned. And I think our strategy, therefore, has been where we see expensive stocks or where we see stocks that have reached our price targets, where valuations look stretched, we've been naturally selling those positions as we would always, but being a bit harder on ourselves in terms of buying and reinvesting in new positions. So making sure that where we do buy new stocks and new holdings, we're really certain about the price we're paying and the prospects for those companies. And we're not buying something ahead of a profit warning or a slowdown. And so that's meant we've raised some cash in the portfolio, so relative to our gearing. So we are now in a net cash position. So we've got more cash than our borrowings in the trust. And also we've concentrated one or two of the portfolios a little bit. I mean, the portfolio is still a very diverse portfolio, which I think is good. But within those sleeves, those geographic sleeves, we've reduced here and there the number of holdings. And I see this as tactical. I don't see this as long term, but it's reflecting, we do need some certainty around trade discussions. It'd be lovely to finally get certainty around Brexit in one form or another. But I just think trying to see where people's sentiment and companies' investment plans are likely to pick up, and that should be a good point to start investing again.